Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern every Monday morning. Get you ready for the week, stocks to watch, economic news that could guide the market. It is a holiday shortened week this week with the markets closing early today, closed all day tomorrow for the Independence Day holiday. That means it's going to be a relatively quiet week for economic news. All except for the spammy and the scammy news that seems to pass for stock market analysis these days. That's why I wanted to take this week's main topic to show you how to find some of the factual stock market data that I use for analysis and some actual news that you can use in your own analysis. Stick around after that and we'll do our Monday market update, stocks to watch this week, economic news, everything you need to see. Before that, revenue shares are running out on our IPO for the channel, so you do not want to wait for this. It's been 2 years in the planning, but I'm finally ready to announce your opportunity to get a share of the revenue from the Let's Talk Money channel here on YouTube. I love my Let's Talk Money community, and I want to offer you a chance to be a part of it. Through an official SEC registered crowdfunding offer, for the first time, I'm offering revenue share securities in the Let's Talk Money channel. Now, regulations by the Securities and Exchange Commission do prohibit detailing the specific terms in a video, so I'm going to link to the offer page in the description below so you can check that out. As an investor, each month, the revenue from the YouTube channel is going to be distributed to investors according to the number of revenue share units you buy. Beyond that, you're also going to get specific perks like access to investor-only live streams and free courses and books. I amended the Form C with the SEC last Friday to open up more diamond tier level shares. Those are the shares that sold out in less than 30 minutes on Tuesday. Those are now again available, so check out that offer page. You're going to see all the perks you get besides that monthly income and the Q&A section to answer all your questions about this revenue share offer. I want to get back to our main topic though, because from bad advice to ads disguised as an analysis and just outright scams, where you get your investing analysis and information from can mean the difference between vacationing in Paris, France versus Paris, Texas. And in today's age of clickbait media, it's become impossible to tell the real news from the fake and the real investing analysis from something that was just written by a freelancer that thinks the balance sheet is just trying to steady a piece of paper on your fingers. That's why I want to share the analysis that I look to and how to use it in your own investing. Now, your best resource is going to be these legitimate news sources like Wall Street Journal and Bloomberg. I like the Journal here because I'm cheap and it's only $10 a month versus $25 a month for Bloomberg. But I'm going to show you a cheat to get some of that Bloomberg analysis free later. I like Wall Street Journal here also because it breaks down into politics, economy, business, markets. You usually just go straight to the markets here, figure out what's happening in the markets. And why I like these most is both of these, Wall Street Journal and Bloomberg, they're both going to be focused on reporting the news. So though you can find some analysis in each. I stay away from the opinion section in both of them because it's all become political nonsense. But by and large, great first sources for information. For stock market data, all you out there in the nation are going to recognize this one. There's no better resource than the FactSet Earnings Insight Report. You just type in FactSet Earnings Insight into Google. It's going to be one of your first results here. Here, Earnings Insight, you click on this, and this is a weekly report. FactSet follows analyst estimates, company earnings, and other data to create that weekly report that is packed with lots of great information and charts. You can scroll down here, and my favorite chart is always towards the end. It's the sector level PE ratios chart. You can always find it here because it's got the blue and green bars all over. But if you look here, it shows the sector level PE ratios, showing you the valuations for stocks in each sector and versus the 10-year average for that sector. So it really gives you a great idea of what's cheap and what's expensive in the market. Another source all you out there in the nation is going to recognize is the sector tracker on sectorspiders.com. This is a sector returns tracker I use every week for the newsletter, seeing how each sector has performed over the last week, month, year to date, longer periods. It's a great resource here and really longer helps you find those opportunities in the market as well as which stocks are leading. For example, in this year to date, it becomes obvious that just 3 sectors here are leading the market by the nose. Communication services, consumer discretionary, and technology all up more than 31%, while the rest of the market really lags badly. And in fact, it really gives you an idea of where the strength is in the market, where the weakness is, and where the valuations might be coming out. You can click through any of these sectors to find which stocks in the S&P are in those sectors, find out where the winners and the losers are, where the valuation might be in each stock, and what the returns are. And of course, the upside to these first 4 resources is that you're getting facts instead of somebody's misguided opinion or analysis. The downside, though, of course, is you're going to have to do your own research and analysis to understand what it means and how to invest. And both the Wall Street Journal and Bloomberg do offer some analysis and direct ideas, but they're largely going to steer away from that direct advice. And I know, folks, it is a lot more work than just flipping on TikTok for some stock ideas, but will make you a lot more money over the long term. Now, for direct stock ideas, there are a few resources you can use, but you will need more caution on what you invest in. And CNBC does report on the news, but also goes into stocks that could benefit with a lot of their articles. And some of the programs like Fast Money are a little like trying to drink from a fire hose, right? Not a good idea. So make sure those stock ideas you have are for long-term investments. Other sites like Barron's and MarketWatch are acceptable resources, some good market analysis, though both are locked behind a paywall. But I've got a secret hack that can get you access. If you have an E-Trade account, which is free to set up, maybe you just put in $100 there, set up your E-Trade account, don't even have to invest it, just let it sit there. You can see some of the MarketWatch and Barron's articles in the news section of stocks featured in those articles. Of course, there's also a certain bowtie bozo here on YouTube that I'd like to think you can trust with your stock market analysis, but maybe I'm a little biased on that, so I'm going to keep this to off YouTube information. Now, I also do use Yahoo Finance for news and analysis, but with a huge warning here, is some of the reporting by the internal team. So those articles attributed to Yahoo Finance itself, those can be good news analysis, a good news feed. But you have to be very careful with the rest of this. The vast majority of the news feeds is just ads and content farms. Okay, when I'm scrolling down here, basically I'm just looking for Bloomberg or Reuters for news. Okay, that's the hack to get the free Bloomberg analysis. Anything from Bloomberg here, you can go through here. We got Barron's, we got USA Today. Let's try to find a Bloomberg. There's a Bloomberg article. So see, if you see a Bloomberg article here, you can click through that. You can read the entire article without having to go through that paywall on Bloomberg. It's a great way to get that news and analysis that you need from Bloomberg without having to pay that $25 a month. I can also see if there's any Barron's articles that I might want to look at here. I can scroll through. If I see any Barron's articles, I can click through here. If there is a stock mentioned in the article, like Tesla is here, I can go to E-Trade. I can look in the news section for Tesla, and most likely that Barron's article is going to be in the news section. So that's another hack to get those Barron's and MarketWatch articles without having to pay through the paywall. Beyond that, I won't say to avoid everything else in Yahoo Finance, but definitely be skeptical of these articles. I mean, this includes anything by Investopedia, Biz Insider, Fortune, Benzinga. I mean, there are some good analysis in these platforms, but their business model is really just to create as much cheap content as they can to attract as many eyeballs and sell advertisers. Okay, so these are just content farms that you really need to watch out for because they're so good at devising those eye-catching titles that appear to be a good stock market analysis, but actually just written by someone that knows little or nothing about investing, if it was even written by a person at all. I'm seeing a lot of content farms written by bots and written by AI already. So yes, looking for this quality content, the factual news, and the stock market data that you can use in your analysis, it is going to mean more time, more research, but will ultimately make you a better and richer investor, okay? Let me know if there's any resources that you use that you feel like you can trust and to include them in the comments below. I want to highlight some of the stocks I'm watching this week. AMC Entertainment, the preferred shares, the ticker APE, could finally get a resolution soon with the company presented its case for conversion in a court case last Thursday. Now, these preferred shares were created specifically to convert into common shares of ticker AMC, but a group of investors, a group of those AMC investors, has been fighting that conversion. It has been pushed back several times by the court, but could get an answer within the next month. Now, shares of APE here are up 18% in the last 6 months versus a loss of 12% for shares of AMC. So shares of APE are outperforming the ticker AMC. I'm up 22% on my position since March, but I'm holding these shares for at least $2 a share on any news of a conversion. Carnival Corporation, ticker CCL, is the third best performing stock in the S&P 500 so far this year. We can go back to this select sector spider if we want here, click through the S&P 500 index 1 year and find those best performing and worst performing stocks. We see our Carnival Corporation, Royal Caribbean, and Norwegian all within the top 10 there. So shares of Carnival Corporation up 133% so far just in the first 6 months. Revenue is expected to surge 74% this year to $21 billion as the industry really recovers from that pandemic, and the company is expected to post a profit per share next year. And while earnings have a long way to go back to that $4.32 per share recorded in 2019, the debt here is what's worried me. Okay, the debt, which has more than tripled from $11.5 billion in 2019. The company owes almost $36 billion and an additional $1.5 billion in annual interest expense. So imagine that, folks. They did make $4.32 per share back in 2019, but now they have to pay $1.5 billion in annual interest expense. That is going to shave off at least $1 or $1.50 in earnings per share going forward for this stock. Now, shares are trading for 19 times next year's expected earnings and probably overpriced in the short term on that 133% run. Advanced Auto Parts, ticker AAP, is the worst performing stock in the S&P 500 with a loss of 53% just in the first half of the year. Higher wages and inflationary pressures are really driving up the operating expenses for this company, destroying profitability on revenue that's barely budged. So revenue growth is positive. It's less than 1% a year. The company posted earnings of $13 a share last year, only expected to produce $6 a share this year. So earnings are halving from last year because of those higher operating expenses, the lower margin. The good news, though, and we can see this going into the financials and looking at the cash flow statement, this business is still cash flow positive, producing $300 million in free cash flow a year and has a strong position in a recession-resistant market for auto parts. Now, I expect management to announce significant cost cuts that might help lower those operating expenses, raise the margins back up, and raise that earnings per share. If that doesn't happen, then within a year, really, the private equity or activist investors are going to come out. They're going to step in and turn this company around. This is exactly the kind of business that private equity activist investors love to come into. It's a cash flow positive, strong cash flow positive. It's leading position in a recession-resistant market. They love to come in here, kick out old management, and turn a company around and make a lot of money doing it. Looking at what the sectors did last week, 6 of the 11 stock sectors did close higher last week with some really interesting notes in the winners and losers here. And stocks in the technology sector, okay, so the largest component of the S&P 500, more than 20% of the weighting in the S&P 500, and really the bull market leadership this year broke down and lost 1.9% on the week. Now, that's only 20 of the 65 stocks in the sector closed lower, though, so it might not be quite the negative indicator as it appears, but investors should continue to watch this sector as any prolonged weakness is going to make it very difficult for the overall market to rise. Again, more than 20% of the S&P 500 weighting is in just this one sector, technology stocks. If that sector remains weak like this and remains to lose on prices, it is going to make it very hard for the stock market to keep going higher. Stocks in energy sector also fell even while the price of oil rebounded and really remains one of my favorite plays, one of the best values in the market. Another trend I'm following here in the sectors, it may still be too early to bet on real estate stocks, but that time is coming. Okay, stocks in this sector posted a loss of 0.43% in the first 6 months and lost 25% last year. Now, higher interest rates to come and just a meltdown in commercial properties likely going to make this year another loser, but investors should keep these REITs on their radar, these real estate stocks. After the 2008 crash, for example, REITs were the top performing subgroup of stocks in 5 of the next 6 years. So an eventual decrease in interest rates, probably next year by the Fed, could be that catalyst for this sector to start turning around, and investors are going to want to be positioned ahead of that time. Again, it's likely going to be another quiet week for the market for economic news. We do see the minutes of the previous Fed meeting released on Wednesday. It's likely going to show that some members wanted to hike rates in June rather than pausing like it did. The minutes should also confirm what the Fed members and Chair Powell has been saying, that persistent inflation is still well above what their target is, and interest rates are going to have to be increased, probably at least once here in July in their next meeting, as well as maybe again later on in the year to bring inflation down farther. The big economic news of the week is going to be the U.S. employment report on Friday, with expectations for just 240,000 jobs created last month. That would be versus 339,000 created in the previous month. That would be a multi-month low for jobs created. The unemployment rate is expected to remain right around 3.7%, and hourly wages should come in right around 4.2% year over year versus the 4.3% pace last month. Now, jobs have been surprisingly strong, though, and expectations seem a little low this month, so I think we're going to beat that. I think we're going to post more than 240,000 jobs created. As long as the wage growth year over year, so as long as wage growth doesn't come up more than 4.2, 4.3, if the wage growth year over year comes in at 4.5% or higher, the market's going to take that as a negative sign on inflation. It's going to sell off. But as long as we don't get some kind of very strong year over year hourly wages data. The market should be just fine with yet another beat on those jobs numbers. Check out that revenue share offer with the link below. Become an investor in the Let's Talk Money channel and collect income from it every single month. Or click on the video to the right for the 7 stocks that will pay your mortgage. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.